The US has always been somewhat more free market oriented compared to Europe. And so that might explain why we in the US have for some time allowed the industry to grow on its own. And it's only now that we are beginning to say, you know what, a lot of companies have fled the US and started operations overseas because of the uncertainty around the SEC. So if we make it very clear what the ground rules are, they'll come back and the US can take its role as a leader of the crypto industry.
This is fascinating, but what is it doing to the banking and financial institutions? It almost seems like, what Uber did to taxis, crypto is doing to banks and financial institutions.
That's an excellent point.
How are they reacting?
That this is a very disruptive innovation.
Welcome to International Business Today, where we discuss the most critical issues in international business with top academic experts and thought leaders. I'm Paula Caligiuri, a professor in the International Business and Strategy Group at Northeastern University's DeMoore McKim School of Business. Today, I am so happy to be in our beautiful new studio, turning the mic on International Business Today co-host Professor Ravi Sarathy. Ravi is my colleague in international business at Northeastern University. He's an expert in global strategy and emerging technologies, and a thought leader on how innovation like blockchain and cryptocurrencies are reshaping international business. Ravi has authored several influential books on global competitiveness and digital transformation. Ravi, welcome to the guest chair of International Business Today.
Paula, it's a delight to be sitting across from you. And this is a slightly different role for me to be interviewed, but I think it'll be fun. And as you point out, cryptocurrency and digital currencies have become fairly central to the global economy. So I think it's a very timely subject to be discussing with you.
Well, let's start from the top, because my understanding, they've been around for a decade, but there's still a lot of confusion. What are they?
As I said, cryptocurrency is digital money. Now, whenever you have an economic transaction, value is exchanged, and that value's got to be paid for. So traditionally, we paid with coins and banknotes, and before that, there was barter and seashells, for example. But banknotes and coins were cumbersome because you had to carry them with you and they could be stolen. And so at some point, the idea of letters of credit came about. I think it was Italy, Vienna, that came up with the idea of a letter of credit, where a bank would more or less guarantee that a merchant had enough credit. And so the letters of credit would stand for payment and could be redeemed at some point. And that in turn led to checks, with people starting bank accounts and paying by check. And then we started having credit cards, which were a form of delayed payment, and you could actually pay partially and owe money to the credit card company or the merchant issuing the credit card, pay interest on it. And we went on from there to wire transfers, to digital payments on phones, that is Venmo, for example, Apple Pay, Google Pay, etc. Now, the problem with any kind of internet-based economic transaction is that when you pay, you need a separate channel. There's the channel through which you exchange the goods and you place your order and receive the logistics, the fulfillment of the goods. But then you also have to pay. And traditionally, payment was done through a separate channel. In other words, you had to give you a credit card or give you a bank account and make the payment. And this involved time. It took a few days for the transaction to settle. So the merchant had to wait to receive the cash. And there was a cost, a fee attached to it. If you use credit cards, it was typically 2.5%, 3%, 4% of the cost. If you did cross-border transactions, it was even higher, 6%, 7%. And of course, it took more time to settle. So the idea of why don't we create a digital version of money that can be instantly exchanged? Now, as you remember from the Napster episode, when music became digital, people copied the file, made multiple copies of it, and exchanged it with one another. What that means is digital money can be spent more than once. So how do you avoid double spend and counterfeiting? Because if it's a digital file, somebody can hack it, copy it, and then use it. So digital money is not that trivial. It requires a fair amount of thought, technology, as well as structure in order to make it work. And Bitcoin was the very first, if you will, digital currency that came about. There's a very famous paper by pseudonymous author Satoshi Nakamoto. It came out, I think, in 2009. And the first Bitcoins were issued shortly after. And the idea of a Bitcoin was that we would use, first of all, verified identity so that you know who was making the payment. You would use a digital wallet, which would contain the Bitcoin. And then you would have a way of tracking the wallet's state so that when you sent money out of the wallet, it would immediately register that the wallet's state had changed and there was a reduction in the quantity of money in that wallet of Bitcoin. And at the same time, a message would be sent to the recipient whose wallet would be updated. And similarly, a state change would take place in the wallet of the recipient.
So it's immediate.
Yeah. So you need to have encryption, verified identity. These were peer-to-peer networks so that theoretically I could just send the money directly to you as long as I knew your digital wallet. This meant that I needed to have a private key to secure my wallet and a public key to let you know who it is that is sending money. And similarly, you as a recipient would have a public key so that I know who I'm sending the money to. And the private key would unlock that transaction and I'd be able to receive the money. So that was the setup. It created a certain level of pseudo-anonymity, not complete anonymity, but pseudo-anonymity, because you were the person behind your wallet, and only the wallet company that issued you your wallet would know who you were. And it was instantaneous. You would have immediate finality and settlement. And it was almost no cost, very low cost. So that was a big improvement over using credit card companies. And there was also disintermediation, decentralization, peer-to-peer transactions, which means you cut out the middleman. So you didn't have to pay
all the financial institutions,
yes,
the banks
right.
are gone.
So in a sense, that is Bitcoin. There's also traceability. Every Bitcoin transaction in a public blockchain, I'll have to explain that in a minute, in a public blockchain is recorded permanently. It cannot be changed. You can reverse it through a separate transaction, just like in accounting double entry bookkeeping. But once a transaction is recorded on a blockchain, in Bitcoin, it is permanent. And a public blockchain, you can go back and trace every single transaction that's been conducted on a blockchain going back to 2009. Right? Now, I mentioned blockchain. Blockchain is a technology that was created and immediately used within Bitcoin. And it involves really, again, encryption, game theory, and peer-to-peer decentralized transfers. So the thing about a blockchain is it's a ledger with a copy of the ledger on every single node that participates in the network. So every transaction is recorded in every ledger. And there is encryption taking place, which makes sure that the transaction has been validated and recorded within a block on a ledger. And if anybody tries to tamper with that information later on, the encrypted number changes and so no longer matches the original encryption. So it becomes very tamper evident that somebody's been trying to tamper with the blockchain. So I could go on, as I said, there's a lot more, but I think in a nutshell that explains both Bitcoin and how blockchain is the underpinning technological layer behind Bitcoin.
No, that makes sense. And actually, it was really a helpful background. There's lots of cryptocurrencies. I know everybody's talking about Bitcoin. Recently, Bitcoin, I think, hit 120,000. What's driving that growth? Is it, tech or speculation? What's going on?
Yeah. If you go back to the philosophical underpinnings of Bitcoin, it was a libertarian undertaking. By that, I mean that it came out at a time when the global financial system was under significant stress. Lehman Brothers collapse, for example, and there was fear that the global financial system was collapsing. Federal Reserve of the U.S. and other central banks got in and more or less patched up the system until the system was able to reach stability and equilibrium again. And that took about 2 or 3 years. So that led to a number of people questioning whether one could trust governments, whether one could trust a government to manage its own money. And the idea was, why do we need governments at all? Why can't we just move to a direct peer-to-peer system of exchange of value by creating a digital form of currency? Now, the one thing about Bitcoin, the one thing about Bitcoin that's really important is that it's capped. the supply of Bitcoin is capped at 21 million. And it never really will reach 21 million because there is a process by which new Bitcoin are mined and issued. And that process continually reduces the amount of Bitcoin that will be issued in a new tranche as we go forward. Mm-hmm. So that the number of Bitcoins issued each time through mining will become smaller and smaller so that you never reach 21 million. So now that means the supply is restricted. Then you think about demand, and Bitcoin used to be viewed somewhat, had a reputational risk attached to it. So most major financial institutions were leery of it. Most individuals did not think that it would be a worthwhile thing to invest in. But there were the true believers who kept buying and using Bitcoin for exchanges, for transactions. And over time, especially with the new administration in Washington, President Trump and his administration, they were much more crypto-friendly. Whereas the previous administration, and really over the previous 10 years or so, the SEC, the Securities Exchange Commission, and other jurisdictions around the world were somewhat suspicious of Bitcoin and wanted to protect consumers against possible fraud and scams. The new administration more or less has said that we want to make the U.S. the crypto capital of the world. There's a lot of innovation happening in crypto, decentralized finance, and we don't want to stifle that and prevent that from happening in the U.S. because of overly strict regulation. So the first thing that happened, I think, was the legitimization of Bitcoin through ETFs, exchange-traded funds. So it was now possible for anyone, you and me, without having a private key, without having a digital wallet, without having to onboard yourself with a certain level of technological sophistication, without all that being necessary, you could just go to Fidelity and say, I wanted to invest in Bitcoin, and what I'm going to do is send you, $10,000. Please buy some Bitcoin on my behalf and store it in my account, just like you would hold shares of a company or treasury bills or bonds or any other financial instrument. Once that became possible, I think that opened up the market significantly. So demand increased, right, for Bitcoin. Now, that meant that both individuals as well as financial institutions could start participating in it. Because there was, as I said, the reputational risk was reduced, so it was now seen as a legitimate form of investment. More recently, the U.S. government has said that they want to hold a portion of their reserves in cryptocurrencies. And just this last week, there was a proposal floated to say that individuals could invest part of their 401ks, their retirement plans, in cryptocurrency if they so desired. Okay, that's one part of it, that the U.S. government has been much more friendly towards cryptocurrency. Really
interesting. So we talked about Bitcoin, but you mentioned there are lots of other cryptocurrencies that are starting to come online. Mm-hmm. Do they have different purposes? What makes them so different? That's a
very good question, because Bitcoin, from the beginning, was intended simply as a form of digital money. It hadn't really thought very much about linking it to business transactions. About 3-4 years after Bitcoin was issued, Ethereum came along. And the interesting differentiator of Ethereum was that the software that created Ethereum also included a portion, a set of instructions that created what are called smart contracts. So in other words, the digital currency Ethereum could be used as payment for economic transactions as long as a certain contract condition was met. So that you could have, for example, a situation where you make a deposit when you rent an apartment. So you make a deposit of, say, 3 months' rent. And the contract says when you finish your rental contract and you turn in your keys and the apartment has been cleaned and there's no damage, we'll return your deposit to you, right? So the payment could be made in Ethereum with a smart contract attached to it, saying these are the conditions under which your deposit will be returned. And when the rental contract is finalized, there will be a message sent to the Ethereum network with this particular transaction, saying, here's the information about the smart contract. Yes, the person has vacated the apartment, the keys have been turned in, the apartment has been cleaned and verified that it's clean, there's no damage, so it is fine to return the money. So it'll automatically be taken out of escrow and be put back into your account. Now, that's just one example, but you can see every kind of commercial business transaction typically being subject to some form of contract. And so Ethereum's innovation was to say, we can create a form of digital money that can lead to automatic execution and payment as soon as the contract conditions are met. And of course, that means you need to have a way to verify the contract conditions have been met and to prevent any kind of hacks where you have somebody giving you misinformation about the contract conditions being met and executing the payment before the contract has actually been fulfilled. So that's clearly, a wrinkle when you create smart contracts. Now, there's also XRP, which is another currency which was created by a company, Ripple, which wanted to make cross-border transactions fast and cheap. So they issued their own currency. They created their own currency called XRP. And the idea was that if you wanted to send money overseas, they had the network in place, a global network, just like the Visa or the SWIFT network. So they had created their own network. And they said, we have a number of entities around the world who participate in our network. So if you want to send money overseas, all you need to do is buy XRP from us, send it on our network. It'll get to the other person via our correspondent, nodes. And the fees are very low. And of course, the interesting thing here is XRP was created out of thin air. The company came along, Ripple, Brad Garlinghouse, and he minted, I think, 100 billion XRPs. And they're sitting in Treasury, and about half of that, 55 billion, have been issued. So this company, by creating this idea of additional currency used primarily for cross-border transactions, was able to then create a currency which is now being purchased by others. And so the company has literally received $55 billion for being able to create a currency called XRP, which uses in international transactions.
But it's lowered transaction costs. It's made it much faster.
Exactly. Very fast, instant confirmation. You have to avoid the whole banking system, which is, there's an issue here, which is legal compliance with know your customer, anti-money laundering, etc. So as these transactions become more mainstream, and they need to be regulated to the extent that they're accepted as legitimate forms of economic use by companies and by individuals, they will need to start complying with these kinds of regulations. And that's really the heart of what the new regulations are about. Under what conditions can cryptocurrencies be widely used?
Oh, there's so much to talk about with respect to the government. The regulation is one of them. This issue, are these eventually going to replace currencies like the dollar or the euro? We need to talk about that. Let's start with that one. How about is there going to replace?
You've heard of stablecoins, perhaps, right? One of the things about cryptocurrency is long-term, Bitcoin has done very well. It went from literally zero to about 120,000 today, right? And same with Ethereum. Ethereum was created by, the Ethereum consortium. And today it's worth about $3,500, I believe. So cryptocurrencies, Bitcoin as a whole has a market capitalization of $2.3 trillion. And Ethereum is the second largest, with about probably $500 billion. So the price has grown significantly over 10, 15 years. But there have been incredible fluctuations in the short to medium term. So the Bitcoin has, as I said, reached 120,000. It was at about 70,000 at the start of the Trump administration, probably. And before that, during the Biden administration, it hit 70,000 and went back down to 40,000. So you have wild swings. So it's hard for investors who don't have a very long-term perspective and confidence that this is going to amount to something someday to stomach those kinds of volatility. And yet, you'd like to be able to use digital currencies for payments. And merchants might say, wait a moment, how can I be in the business of selling clothing or cars or renting apartments if I'm getting paid in a currency which could change 20, 30, 40% in value in the short term? So stablecoins are a way of trying to give the benefits of a digital currency without the volatility. And the way you do it is very simple. Let's say I want to issue stablecoins. So I take a certain amount of money, $10 billion, put it into segregated, safe reserves, and then issue an equivalent amount of digital currency, 10 billion stablecoins. And so there's a company here in Boston called Circle, and they have a stablecoin called USDC, US dollar Circle, and that's partly how they do their business. And their total number of stablecoins issued is around $70 billion. The biggest in the world is Tether, Tether, US dollar Tether, and it's a company outside the US, and they have issued around $150 billion worth of stablecoins. And the difference between these two is Circle is very insistent in being compliant and publicly announcing its compliance with US laws around know your customer, KYC, anti-money laundering, prevention of trafficking, drugs, arms, human trafficking, etc. Whereas Tether has run into problems with the US regulators because it is outside the US and is seen as not being fully compliant with these kinds of regulations. And the Genius Act, which was recently approved by Congress and the Senate and signed by the president, regulates stablecoins by clearly specifying what kinds of reserves can be held, against which stablecoins been issued, where should the reserves be held, in other words, how should they be segregated so that they're not commingled with the company's funds and segregated, and liquidity, how can customers buy and get dollars back if they decide to sell stablecoins. There are a few other provisions, but that's the heart of the matter. The stablecoins are now regulated, and anybody who wants to, as long as they follow the regulations, can issue their own stablecoin.
So the purpose of the regulations is what? To protect consumers, build trust?
It is to create a transparent and clarity for the use of stablecoins. Because it used to be that there were stablecoins that are called algorithmic stablecoins. And there was a famous case of a company, Terra Luna. Terra and Luna are two separate coins, and they wanted to issue stablecoins, but they were algorithmic in the sense that they didn't hold one-to-one reserves. They used an algorithm to decide how to stimulate buying and selling of enough stablecoins to keep the price in equilibrium. At one-to-one. Unfortunately, that algorithm failed, and Terra Luna lost value, and I think it went from $1 parity to about 7 cents. Oh, wow. And so there have been examples, and occasionally even US dollar Circle during the Silicon Valley Bank crash had a significant portion of their reserves held in Silicon Valley Bank. So when that bank crashed, there was some question about what's going to happen to USDC because some of the reserves have been compromised and they may not be able to recover those reserves. Fortunately for Circle, the U.S. government stepped in and guaranteed the deposits of Silicon Valley Bank. So U.S. dollar Circle's deposits against which it issued its coin was safe.
Oh, wow. So Ravi, talk to us a little bit about this regulation. You're starting to mention some of these things that are helping.
As you probably know, the SEC, the Securities Exchange Commission, and the CFTC, the Commodities Futures Trading Commission, are the two major organizations that regulate this area of cryptocurrency. The big question is it a commodity or is it a security? If it is a security, it must be regulated by the SEC. If it's a commodity, CFTC takes over. The SEC's main issue is protecting consumers against fraud and making sure that there's full disclosure by issuers of securities so that you know exactly how to value the security. And so the SEC was very reluctant to authorize many crypto businesses because they weren't sure that there was enough consumer protection, enough disclosure, enough weight behind the companies starting these various crypto businesses. So as I said, the Stablecoin Act made it very clear how stablecoins could be issued and regulated. Under what conditions could a stablecoin company operate? More recently, there's been an act called the Clarity Act, which is about regulating the entire crypto industry, creating standards for disclosure, for the kind of people backing the company. How could the company's business purpose be clarified? How could investors be able to do due diligence before investing in crypto companies? What about liquidity and those sort of things, right? And also reporting. reporting on a regular quarterly basis like all other companies, so that information is continuously updated and available. And that's the Clarity Act. And then there's a third act called the Anti-CBDC Act. CBDC stands for Central Bank Digital Currencies. And this was the idea, and this was the BIS, the Bank for International Settlements in Geneva, in Basel actually, has been studying CBDC for a while, and it's primarily an initiative of central banks around the world. And they estimate that perhaps 80 central banks around the world are experimenting with CBDC pilots. In other words, governments around the world are experimenting with issuing official digital currencies. So we have stablecoins, which are digital currencies that are stable, but are issued by private entities. And as we know, there's been occasional questions about how do we make sure that there is enough reserves underlying the stablecoin. So many governments around the world are thinking that it'd be good to have the official imprimatur of the government behind a digital currency. And so that's why it would be called a central bank digital currency. And the issue there is you'd be competing with private stablecoins. So that's, I think, the reason why the U.S. government is opposed under the current administration is wanting to create an anti-CBDC Act to prevent the U.S. government from issuing an official digital currency, partly because they feel that there's be privacy issues with individuals and entities worried about what will the U.S. government learn about my economic transactions if it is an official digital currency. Because remember, if it's official, you have to monitor it to make sure that the transaction is legitimate, that the counterparties are correctly identified, and the right amounts have been, sent back and forth, right? So there's a certain amount of record keeping that is necessary for the system to work correctly. The issue becomes, how long will that information be kept? Who has access to it? And how might that information be used? Now, having granted that today's world, private companies have that information, okay? Mm-hmm. Fidelity has information, Goldman Sachs has information, Amazon has information, Meta has information. So the nub for the US is it's okay for private companies to have information about you, but we don't want the government to have it. I believe other countries around the world, Europe, Japan, China, etc., have fewer qualms about.
Is their legislation a little bit more advanced then?
Well, China has been experimenting with the digital yuan, okay, ECNY. Europe has been experimenting with the digital euro, and they have a set of regulations called MiCA, M-I-C-A, which was actually passed, I think, over a year ago, probably 18 months now. And MiCA very clearly sets up the ground rules and the terrain in which crypto industries can operate, and sort of indicates what kind of disclosure requirements are necessary for a company to issue stablecoins, and how can cryptocurrencies, which are not stablecoins, right? How can cryptocurrencies be issued and regulated, et cetera, et cetera. So MiCA is far more advanced, if you will, that they've been looking at it more carefully, but at the same time, they also know that because they control the euro, which is 29 countries, I believe, they need to be somewhat more forthcoming and advanced in regulating this industry because so many countries are involved. Okay? The US has always been somewhat more free market oriented compared to Europe. And so that might explain why we in the US have for some time allowed the industry to grow on its own. And it's only now that we are beginning to say, you know what, a lot of companies have fled the US and started operations overseas because of the uncertainty around the SEC. So if we make it very clear what the ground rules are, they'll come back, and the U.S. can take its role as a leader of the crypto industry.
This is fascinating, but what is it doing to the banking and financial institutions? It almost seems like, what Uber did to taxis, crypto is doing to banks and financial institutions.
That's an excellent point.
How are they reacting?
That this is a very disruptive innovation. If you think about what banks did, banks took your money, gave you some interest on it, and then lent it out to other companies. And there was fractional reserve banking, so that for every $10 they had in deposits, they might loan 2 or 3 times that amount, as long as they had reserves with the Federal Reserve. And so the idea was not everybody would be taking out their money at the same time. So it was okay for banks to essentially create credit for the economy. And this is fundamental to the economy because credit is what allows companies to grow. And so if you have stable coins coming along, Now, the interesting thing about the stablecoin business model is that you and I will give money, our dollars, to buy a US dollar stablecoin, right? So we've taken the money out of the bank and given it ultimately to USDC, Circle, or to Tether, or to one of the other companies, including the Trump family, who started their own stablecoin. There is no requirement that the stablecoin companies pay interest on the money that you have used to buy the stablecoin. So to the extent that US dollar Circle has issued $70 billion worth of stablecoin, they've received $70 billion that they're holding in reserves, US Treasury bills, which are earning interest. But that interest is not being paid out to anybody. So that interest can be used by Circle to pay for its expenses, developing new businesses, new product lines, new service businesses, and the rest is profit. So USDC went public recently. Circle went public recently. And if you examine their IPO documents, you'll see that the biggest chunk of their profits comes from this interest earnings on money deposited with them to be able to issue stablecoins. I don't know how long that can last, because you do see some attempts to create what are called decentralized finance businesses around stablecoins as a way of rewarding people for buying and holding stablecoins. So my personal feeling is that gradually people will be able to earn interest on stablecoins, maybe not at the same level as with the US dollar bank deposits. Now, getting back to your question.
Disruption.
If a bank loses deposits to the stablecoin industry, it can lend out less money because its total loanable funds are less, and therefore its total credit creation is less. And that could be an issue because without credit, companies will not be able to grow as fast. That's one issue. The second is that overall bank profits will decline. So banking stocks will probably be less valuable. Price earnings ratios will fall, and some of the weaker banks could go out of business and be supplanted by cryptocurrency companies, by decentralized finance companies, by stablecoin companies. So long term, if I were a bank, I'd be saying, if you can't defeat them, join them.
I was going to say, get in the game.
Yeah. So the banks are now legitimately allowed to issue stablecoins. The stablecoin industry does not say you can't do it. As long as you follow the regulations, you can issue stablecoin. So banks are beginning to start thinking about issuing what are called deposit tokens, where if I have an account with you, then if you want, I can get tokens in the form of digital tokens that represent the money in my account. And then I can send it out as payments. I can use it to buy property. I can use it to buy equities. I can use it to make purchases of any sort.
But as before, transaction costs will be lower. It'll be faster, right?
Yeah, okay, right. Okay. And the other thing is the merchant. If I'm a merchant, I'm currently, paying 2-3% of the credit card companies and paying maybe 1% for Venmo type transactions. And stablecoins allow me to avoid a significant portion of that cost. It also reduces the float. So rather than waiting for a certain period of time and holding that receivable until I get paid, that float gets reduced. So the total amount of working capital I need is far less.
Interesting.
So those are two very big benefits to companies, to merchants especially, in terms of using stablecoins. The downside is if I'm a customer, credit cards allow me to, if I pay it off fully, credit cards allow me to postpone paying for about 25 days. Right, 30 days. And secondly, I earn interest on my bank deposit. So if I move to stablecoins, I lose the interest and I have to pay the money immediately. I don't get the free access to credit for about 25, 30 days. So that's going to be interesting to see how that plays out over time. But I will tell you one thing. Today, about $250 billion worth of stablecoins are in circulation. And I've seen estimates that within 2 years, the total amount of stablecoins in circulation might be around $2 trillion.
Wow.
Okay, this is a standard chartered bank estimate. Wow. And that in turn would mean that out of the $2 trillion worth of stablecoins, about 1.2 to 1.6 trillion will be US Treasury purchases. Because you can't issue stablecoins without owning US Treasuries. So this stablecoin industry is going to be one of the biggest purchasers of US dollar Treasury bills. And so even if China refuses or stops buying treasury bills for geopolitical reasons, etc., you got a whole new
Stablecoins ready to take it.
And now that's going to have implications for monetary policy, for managing monetary policy, money supply, interest rates, etc. So that's a whole other very long-term question that's going to arise.
Let's keep going there with the long-term issues. So, as crypto becomes more mainstream, are there potential risks like we saw in 08 with Lehman Brothers? Are there some real risks here?
One risk is, how well will stablecoin companies comply with the regulations surrounding holding reserves and segregating them and holding them in certain forms, U.S. treasuries, banknotes, safe, liquid investments? And secondly, how well will that compliance be enforced? In other words, the regulators, how well will they be able to regulate these stablecoin companies? Because you have two levels of stablecoin companies, federally regulated and state regulated. This is under the law, under the new Stablecoin Genius Act. So will all the states, all 50 states, regulate them at the same level of discretion, and will the same rules apply everywhere, or will there be some weaker states where some of the less ethical companies might say, hey, let's start a stablecoin company in that state because the regulators are lax compared to, say, New York or Texas. And so you may see some issues arising. But another issue is this. Stablecoins are instant transactions. So if I'm a consumer and I made a mistake and some money left my account without my authorization, or I made a mistake and I sent twice as much as I planned, or I sent it to the wrong account, wrong merchant, how do I reverse that transaction? So consumer protection is going to be very important. We already have depositor protection under the current banking system up to $250,000. So if I lose my private key, what happens then? Is my money lost, or is there redress? So I think that kind of consumer protection needs to be fairly strong in terms of being able to reverse a transaction or revisit a transaction. In some form of complaint resolution needs to be in place. Now, longer term, you were asking about the promise of this industry.
Yeah, so let's flip it around, right?
Yeah.
Yes.
I think that one very interesting thing is there'll be more competition for the traditional finance. So investment banks, brokerage houses, large systemically important banks, all of these will now be facing more competition. And generally speaking, more competition is good for the consumer because it will create more innovation, more range of products and services to purchase, and possibly lower costs. Right?
But there's also financial inclusion, right? I mean, more people have access
Financial
to...
inclusion is a very important topic. The U.S., perhaps, 10, 15% of the population may not have access to banks and bank accounts, but around the world, the proportion is much, much higher. And the thing about stablecoins, about cryptocurrencies, is they're global currencies. You can use them not only within one country, but all across the world, because all you're doing is sending a message through the internet to some other location. It can be anywhere in the world. So if I'm a citizen of a country where the government is weak or corrupt or economically not very adept, and so the currency depreciates significantly over time, you might say, I would rather hold some of my assets in a strong currency such as the US dollar. And there has been talk about de-dollarizing the world economy, reducing the weight of the US dollar and increasing the use of the Chinese yuan or the euro or some other currency. I think that this stablecoin phenomenon will make it much easier for citizens around the world to hold US dollars in stablecoins, which would mean that their assets are less likely to depreciate because their currencies were depreciating faster than the US dollar. And it increases the role of the US dollar in the world economy. So paradoxically, by offering stablecoins and legitimizing them, you're making it more possible for the world to continue to use dollars as part of how you conduct global economic transactions, even though countries like Russia, China, Iran, Venezuela, etc., would love to see less use of the US dollar. Okay? But at the same time, because you have cryptocurrencies, it's easy to evade sanctions. because the whole idea of the formal banking system is very strong regulations around know your customer, etc. With cryptocurrencies, there is always going to be a certain level of illegal, illegitimate use and transactions taking place. It's not large. I don't want to overestimate this. It's probably 3 to 5% maximum. So most of it is above board legitimate transactions. So that's going to benefit enormously from faster transactions, lower cost, speed, pure identity verification, etc. But there is going to be also the possibility that as more of these stablecoins and cryptocurrencies are issued, there'll be more room for money laundering, for weapons trafficking, for avoiding sanctions of various sorts.
So let's assume that the regulations go into place, that some of this is checked over time. Help us see around the corner. If in 5 to 10 years we really do have a healthy cryptocurrency standard around the world, what does that look like?
Well, for one thing, merchants around the world will need to think about how to accept cryptocurrency payments. Now, as I said, stablecoins, you don't need to worry about too much. There's a small transaction fee, but it's stable. But if you're a merchant, you really don't want to be messing around with cryptocurrencies that can be highly volatile. So you need to think about, as a merchant, do I accept any form of payment, including cryptocurrencies? And if so, how do I make sure I don't get hurt by volatility? Because my business is making cars, making clothes, offering hotel services, etc. Right? So I want to earn money from my core business transaction, and I don't want that core business transaction profitability to be prejudiced by volatility in the means of payment that I'm accepting. So companies will have to start thinking about global payments, how to set up the global payment infrastructure, how to make sure that they're secure, because that's a very important part of this whole network, security, and how to make it very, very easy for customers to onboard and to make payments. And I think smaller companies will definitely have some issues here. In joining this global network, in getting the secure nodes set up, and so there's going to be more, I think, value-added services being offered, third-party services that'll help small and medium-sized companies cope with this new, digital currency-based global payments world. That would be one thing. The second is, I think, from a company perspective, should they be holding some of their own reserves? There is a phenomenon called digital asset treasuries that's coming up. These are companies that have said, we normally hold a certain amount of cash in our, as part of our transactions, right? We need it for making payments, as a emergency reserve, to be able to buy equipment, to be able to set up new factories, et cetera, et cetera. And so there's been questions about, should companies start holding a portion of their reserves in cryptocurrencies? The best known example is a company called MicroStrategy. Michael Saylor is the CEO. He began this strategy probably 5 or 6 years ago. His company is now probably one of the biggest holders of Bitcoin as a corporation. And he's done enormously well because he keeps buying Bitcoin with spare cash. So that today, even though MicroStrategy was set up as a software company, doing enterprise software, today they're primarily a Bitcoin ETF. And so the digital asset treasury is going to be an important question. How will companies around the world start thinking about what role should cryptocurrencies, stablecoins play in their holdings of cash within the company, right? And then the third is, how can they start using cryptocurrencies and the innovation underlying cryptocurrencies in their own economic models? As I said, blockchain is very much a part of cryptocurrency. And strangely enough, blockchain kind of was treading water for over a decade, over 15 years, because nobody could quite figure out how to get blockchain to work at commercial scale. Blockchain had a problem of reconciling speed, scalability, privacy, decentralization, validation, consensus to validate that a transaction occurred and is legitimate. So these are all issues that arose with Bitcoin, with blockchain. And so blockchain never really took off in a big way outside of Bitcoin and outside of the cryptocurrency arena. So I think these kinds of developments, you're going to see more and more interesting innovations taking place, like smart contracts, like what are called layer 2 technologies, which are being built on top of layer 1 basic software underlying Bitcoin and underlying Ethereum, underlying Solana, Avalanche, Tron. These are all, various different innovative efforts. Chainlink, another great company in this space. So the innovations that they're taking on will, I think, will start flowing into the overall economic sphere. And more companies around the world will be able to use these kinds of innovations to say, we should also be thinking about doing some of that, borrowing some of those innovations and thinking about how to use it in our own businesses to make our businesses that much more innovative, that much more efficient.
Ravi, it feels like we could have you on the show every 3 months and something would be a completely different conversation, but that's really helpful advice to help us see around the corner of what could be, what the potential of the future could be. So what's your best piece of advice that you would give global leaders who are trying to better understand either the blockchain space or the crypto space?
Well, if you're a company, I think you, as I said earlier, you have to start thinking about accepting payments in digital currencies, setting up the infrastructure to do it securely and efficiently and at low cost, to start onboarding talent, either through directly hiring people or through working with collaboration with third parties, with value-added resellers, to start thinking about how do I become part of a global payments network? How do I make sure those nodes are operating securely 24/7? How do I do the maintenance? How do I do cybersecurity protection against these things, right? So I would say that would be one of the biggest things. And the second is, I think, digital payments are here to stay. Cryptocurrencies are here to stay. They're not going to go away. And so from an investment perspective, I think most people have a risk profile. So people who are somewhat more willing to take risks, the portion of their portfolios that are risk-oriented, a proportion of that risk-oriented portfolio could be started to be invested in these more high-risk cryptocurrencies and new cryptocurrencies that are coming up and coming up with new innovative solutions for this industry. One of the things I forgot to mention, AI. There's a tremendous amount of interest today in terms of combining AI with blockchain, combining AI with cryptocurrencies through what are called AI agents. So that AI agents will facilitate micropayments so that you could have a news company, local news is dying. Local news is being put out of business by the major sites like Google and Meta, right? So local news companies could start trying to figure out a way to use local news and make it available on a tailored basis to individuals who want to hear about local events taking place, local artists, local services coming up, local anything in your community that's of interest to you, and making available local news and having individuals pay using AI agents, which would automatically calculate how much they've accessed a news site, how much news they've consumed, what would be the cost payment or payment involved for that news site, and then automatically pay with stablecoins or other crypto entirely seamlessly in the background without having to involve any effort on the part of either the news supplier or the news reader. Okay, so AI agents combined with global payments are going to become very, very critical to the future of the global economy.
I mean, it sounds like the best piece of advice is stay on top of it. It's coming for your company, it's coming for your business, but it's also something that you could benefit from individually.
It's not something to be scared of. It's not something to be scared of. There's some real value here, some real interesting innovation taking place. So I would embrace it and start learning about it if I haven't already done so. Find bright young people who are likely to know a lot about this. Try to get them inside your company and learn from them.
Thank you, Ravi. Thank you so much. This was excellent.
Paula, thank you for having me here. I love to talk about this stuff. I could, as you say, go on and on. But thanks again.
It's great. To our listeners, thank you for joining us for this episode of International Business Today. If you enjoyed the episode, don't forget to hit the subscribe button. Please know that your 5-star reviews mean the world to us, helping others discover the show. Until next time, stay curious and send us questions. We'd love to hear from you.